Hi everyone, Sam Hadden here. If you're interested in building your wealth or learning about property investment, then I'm going to do my absolute best to make this short video a incredible value for your time. So what I'd like to do is give you a quick high-level summary on things like financial goal planning, a few property investment strategies, how you can do things like pay off your mortgage faster, reduce your taxes, build a multi-million-dollar property portfolio over 10 years, and build a passive income. And then we'll talk a little bit about the landscape of the economy, in particular Perth, and the landscape of the property market as well. So I'd like to share a quick slide with you about myself and why I might be worth listening to on this topic for you. So again, Sam Hadden here. I'm a wealth and property investment coach. I've been investing for 13 years. I bought my first property in 2009, and I had 3 properties before I was 25. I now manage 7 properties, as well as things like shares, managed funds, crypto as well. And I have certification in real estate, REIWA and DEMIRS. I studied professional finance with the Monarch Institute, and I've been a member at Infinite Wealth for 10 years as well. Now, what I find is that financial knowledge and investment education is just so important, but it's really neglected. And whether you decide to work with me or not after this video, it's my absolute commitment that I give you some valuable information today as well. So, you know, some of the things that you might be going through in your life is you might be frustrated about not getting ahead or worried about how you're actually going to reach your financial goals or retire. Maybe you know you're paying too much taxes, want to know how wealthier people are doing it. You're confused about what's going to be the right strategy for you, and maybe concerned about the economy and what's going on out there as well. That's why what I do and my team at Infinite Wealth do is grounded in education. What we found is that there's a lot of people out there who would like to build their wealth, would like to invest, but they weren't taught this in traditional education. So what we do is we have a team of experts here. We use our experience, and we also use independent research and studies to empower our clients to make those educated decisions as well. And what I've also found, and the government actually did a survey on this, is 78% of people have no long-term financial plan as well, how much they're going to need, when they're going to need it, and how they're going to get there. So we help our clients as well to design specific strategies, personalized strategies for you, how you're going to achieve your financial goals and tackle every financial area of your life as well. And then the third thing is that most people don't have enough time or expertise or the inclination to go out and do all of this stuff themselves, especially if you've got a family and a job and all those kind of things. So I've got a team of experts that I work with here as well, which I'd like to share with you, that actually give you that peace of mind and some of your time back. We have Infinite Wealth, which is a team of wealth and property investment coaches. Our Infinite Property team are buying and property management experts. So we do research with some of the top researchers in the country, Terry Ryder, John Lindeman, SQM Research, CoreLogic, to help us to do independent research on the property market and then actually help our clients to go out and buy properties in the right areas. I work with investment savvy mortgage brokers as well. So not your traditional broker who might work for the bank or just do really sort of standard finance. Investment finance, finance structuring, very, very important. And financial planners as well are important to work with because, of course, they help with retirement planning, superannuation, maybe personal insurances, things like life and death and income protection as well, and maybe self-managed super funds is another investment structure that we work with. And then, of course, accountants, because tax minimization and being tax effective, especially with property, is incredibly important and something that not many people get right as well. Now, did you know this is the biggest problem? One of the reasons why I do what I do. 9.1% of Australians are self-funding their retirement. They don't have enough investments. 91% of people just falling short. 30% of people have no super at all because they've been self-employed or a sole trader. 42% of baby boomers, people in their 50s and 60s, expecting to work until they're 70. That's something that hits me home very, very hard. My old man was very stressed about money, worked very, very hard till he was 66, got brain cancer at 67, didn't even get to enjoy that retirement. In 2022, the average superannuation balance for a 55 to 64-year-old was approximately 324,000. Not much to sneeze at, but you don't need me to tell you it's not going to get you very far. 83% of retirees relying on the pension, which is about $20,000 to $35,000 a year, by the way. Not sure if you're that keen on that. But yeah, a lot of us are paying way too much tax, don't have enough investments, and we are addicted to our jobs and our income. Very much the Australian way of life. We are the lucky country, the land of the middle class. We have a great quality of life. Get an education, get a job, kick the can down the road, rely on the government, pension, and don't actually go out and make any sort of portfolios for ourselves, which is why we're all falling up short. Now, Simon Sinek says, start with why. So for me, it's all about, financial goals and thinking that far ahead and going, okay, maybe do I want to travel more? Peace of mind, security, dream house, dream car. I mean, financial freedom is different for everyone, right? Family, kids, setting them up and giving them the life that they deserve, having independence, or maybe an early retirement if that's something that appeals to you. And then working out how much do you actually need? Is it a $2 million retirement base or $3 million worth of assets? Do you want a passive income of $100,000? How much is it? Then there's financial freedom or passive income, right? That is really what it's all about. Like if you have more money coming in than you need, you are financially free. But what we use here is a formula that has been very common practice in the financial planning world. The Australian government use it as well. For every $50,000 in passive income you wish to generate, after tax, by the way, you'll need $1 million worth of net investment assets. Now, point number one, this does not include your own home. This is the biggest mistake a lot of Australians make, is they count all their wealth in their own home. They follow the Australian dream, but you need to live somewhere and you can't eat your house, right? So that's not going to provide you that additional lifestyle that you need. So for 100,000, you need $2 million in investment assets. Now, I teach my clients to play the rule of capitalism, and to really just simplify it, right? I could talk about this a lot, it's really earning an income and then paying yourself first. This is in a book from 100 years ago, The Richest Man in Babylon. You need to take a percentage of your income, 10 to 20% ideally, before you do anything else with your income. That money goes towards your future, goes towards an asset base. So into assets, and then assets will create capital growth and a passive income. Warren Buffett, famous investor in the world, says, if you don't find a way to make money while you sleep, you will work until you die. Okay, pretty grim. So why property? I'm very unashamed of growth property. I think it's a great vehicle for people to build their wealth. 90% of millionaires around the world use real estate. It's consistent, it's stable. For the last 60 years, the ABS says that the average growth has been 8.2%. I only use 6% in my portfolio modeling. You can borrow money to buy it, which is called leverage, and I'm going to get to that. You create rental income, tax benefits. It's always in demand. People always need shelter. We have huge population growth. Creates a forced form of saving, having your money work for you. It's the largest economy in Australia, worth nearly $10 trillion, 9.8. And debt, for anyone who thinks might have a debt problem, is only at about 2.5 trillion the last time I checked. So we're at like less than 30% debt to value ratio on properties. And the government has a massive vested interest in this. So for them, they only supply 3% of government housing. That's one. But two, it creates a wealth effect, right? More people have more money in their properties, the more money they spend in the economy. Plus, it's one of the biggest employment industries for tax and everything that comes with property. So the government massively have a vested interest. The growth that you get in your properties in equity can be used to reinvest tax-free. I'll get to that. And it's a lot easier to understand for most people, and it's less volatile than shares and things like crypto these days as well. Now, this is a study, CoreLogic, over 30 years. You can see all these different major timestamps when the property market boomed and went down, and all the different things that have affected it, government policies and lending policies, etc. But what I want to point your attention to with this one is that in 1992, at the bottom of this graph, the average house price in Australia was $200,000. It's now $928,000. That's like a 360-something% capital growth over the last 30 years. So when you think about the long game of property, how many of them would you have liked to have bought a couple of, 30 years ago if you were that generation? So now the main reason why property is such a powerful investment and it allows people to grow such a bigger asset base is a term called leverage, which some of you more experienced or financially savvy people out there may have heard of. Basic example here, guys, high level. So shares, if you had $50,000 and you put it into a share portfolio, the average was 9.7% over the last 30 years. You get 12% here. That's $6,000 you'll get return on that investment. Now, with property, minus a bit of fees and stuff, we're not going to get into that. $50,000, you could buy a $500,000 property, at 8%, which is the average growth. That's $40,000. Now, even if I bring that down to 6%, that's a $30,000 increase, which is 5 times the increase that you had on your shares. So basically, we're using the bank to drive a larger asset base, okay? Now, what I'm going to do is I'm going to jump on the board, show you a couple of different methodologies here and give you a bit of context. Over here on the left-hand side, now you've got the bank. So essentially, they're a business partner. They've funded most of your investment, about 80 to 90% of it. Then you've got 2 other business partners here. Now, I say business partners because you want to treat a property investment like a business, and the tax office does the same thing. So depending on your tax bracket, but I'm going to use an average of 30%. If you pay more tax than that, this is even more beneficial to you. What that means is if I spend $1 on the interest on the mortgage or $1 on maintenance, I will get 30 cents back, okay? Then the tenants are paying 55 to 60% on a good property investment, and that's going up a lot, by the way, with the current market. So you're left off paying 10 to 20%. So everyone else is paying 80 to 90% of your asset, and over time, they will actually pay for 100% as rent goes up. I'll go into that as well for a second. But guess who owns 100% of the asset? If that property goes from 500 to 600 to 700, that's 100% yours, okay? So I'm going to use an example here, assuming that you might be somebody who owns your own home. Now, let's say in this example, you have a $600,000 property. If your mortgage is 400, obviously you have $200,000 worth of equity in that home. Now, if we take 100,000 out and create a second mortgage, it can be called a line of credit, anything else like that, we can use $100,000 to go and invest. Now, I'm going to create an important distinction here. Most people, there's a red P there against your $400,000 home mortgage. That's a red P for personal debt. Personal debt is not tax deductible. Any debt you use to invest is tax deductible. So we take this 100K out here. We can go and use that for a deposit and fees and anything else we might need to go out and buy another property. Let's say we buy a $550,000 property, okay? Now, again, that also has investment debt, which is also tax deductible. Now, I'll show you on a spreadsheet in a second. We want to allow about $200 a week. It's going to be negatively geared slightly. After rent's paid, you get tax back, all the expenses paid on the property. So $200 a week. Now, you might say to me, oh, but Sam, I'm increasing my mortgage. I've got more debt. I'm paying $200 a week more, and da-da-da-da. Well, what if you took that $200 and you put it into your personal home because you're going to pay off your personal home fast? That's what most people do. If you had a 30-year mortgage, right, you might pay it off in 20 years. Okay, might seem good to some people. Well, let me show you another scenario. Use that $200 a week, take out a bit more equity, go buy another house. Let's say this house grows at 5% over 10 years. It's over 800,000, but we'll use 800. We take off $400,000 worth of mortgage. We'll say you've still got left at that time. What does that leave you? 400K. Now, what could you use that for? Well, of course, you could go and buy more properties. But what you could also do is use it to pay off your personal home. And now I've paid off your personal home in 10 years rather than 20. So you can start to see the power of leverage and using other people's money here to drive a larger asset base, okay? So imagine, you know, you had 2 or 3 of these creating you an extra $400,000 over 10 years. You're a millionaire, right? And a lot of people can't get there by saving, and a lot of people won't have the inclination or the confidence, I was going to say something else, to invest into shares to create $1 million over 10 years. You know, just want to really have a look at, you know, what you're doing and have a look at where is it actually taking you. And saving and doing what most people are doing is not going to get them that kind of level of growth over time. So I'll come back in and go back to a few slides here because I've got a bit more info to show you guys. I hope you're keeping up with me. So we have here a property cash flow analysis here, one of the things to do with our clients. So we start up with a property, 550. We're paying 6% interest now these days. 550 in rent. We're actually getting 600 plus on some of our properties now. And we're going to get tax back. We're going to have depreciation, all these different types of things. The property, you see on the bottom right-hand side here, paying principal and interest $203 a week. But if you paid interest only, it's only going to cost you $88 a week, which is really the only money you're losing here because principal is paying off your loan. So the summary at the bottom here, we can see $10,000 or $200 a week, excuse me, is going to get you $6,000, $5,900 reduced off your loan. If it grows at 8%, $44,000, then we lose $4,600 in interest. So we've got a net personal wealth increase of $49,900, call it 50 grand. So we've got potential to turn $10,000 of cash flow into $50,000 worth of equity. How many of them would you like has got to be the question, right? Now, there might not be some years where it goes down, goes up, but over time, the average is definitely going to be in your favor. So then we use the chain reaction, which is the overall strategy here. Start with a plan, structure, buffers, leverage property into property, then diversify into other assets over time. A roadmap of how this would all come together is, you start off with one property, then year two would be able to get another one, then maybe a couple of years before getting the next one, and map this all out at an average growth rate of 6%, average interest rate of 6-7%, and then we get to this 10-year goal of having $1.5 million worth of equity. Now we can start doing other things, use a financial advisor, invest into shares, maybe businesses and all those kind of things as well. And after 15 years, we could have $3 million worth of personal net wealth. So how do we help people buy properties? So property research, 31-point checklist, checking crime, unemployment in the area. It's really important to check the government infrastructure plans, look at the amenities, the rental yields, the average growth in the area as well, population growth, job and employment nodes, affordability as well. We help our clients to buy properties using the relationships that we created over the last 11 years. We help our clients to buy about 200 properties a year. So we work with some of the top builders, developers, real estate agents, and because we bring them so much business, we know exactly where we want to buy. We can save them on marketing, advertising, commissions, overhead costs, prolonged interest. We communicate with the banks, builders, and settlement agents for our clients. We do project management, depreciation schedules with a quantity surveyor, independent building inspector, and we do all the contract due diligence to make sure that everything is all as much in your favor as possible. Now, the next question you might have for me is this the right time? Is interest rates going up? There's global turmoil going on. America went into a very slight recession. Looks like they're out of it already. Now, what we want to focus on specifically when it comes to WA and Perth is the local economy. Okay, there is not just one property market within Australia. Sydney and Melbourne might be going through a rough time, but we are massively coming out of it. Local economy and unemployment is extremely low here and extremely strong economy. We have population growth second highest in the country. We have the second highest incomes only to Canberra, but all the other capital cities we beat. We have some of the record low supply of availability for properties. You're seeing people go 30 people through a home open right now, 15 people making an application, and people offering an extra 50 to 100 bucks a week rent to get a property. It's the same thing on the sale market as well. So we have a big supply and demand issue. Where are we at in the market cycle in the global economy? And the availability of credit, which is how much money do the banks have to lend and how much are the regulators allowing them to lend, which you'll find since 2019 has been massively tilted towards having high money on the books. All the big institutions, all the big banks all have tons and tons and tons of money, and the regulators are loosening the credit strings. The only thing that's happening is interest rates are going up to curb inflation because the economy is too hot. Rental income as well for property investors is going through the roof. There is no way that this rental crisis is going to end anytime soon. It took 7 years to create it. It's going to take a lot longer to get rid of it. I'm going to whiz through a summary about WA, guys, and then just you can make your own decision and we can talk about this further if it's something you're interested in. We have the highest average weekly earnings out of the main states. We have our mining and resource sector absolutely booming. We have lithium, we have oil and gas, we have iron ore, we have gold. We have the lowest unemployment across all the states. We have the second highest population growth, high GDP, 1.5 jobs for every one person unemployed, the highest out of all of Australia. Mining industry tipped to make $450 billion with 107 new projects being started. WA, second highest population growth according to the ABS, set to overtake Brisbane by 2029. Australian household wealth is at record highs. We have record high equity in properties. 40% of the population are 24 months ahead on their mortgages, record high savings and liquidity in investment funds. Perth, very much still in a rising market. Adelaide's still got a bit to go. Brisbane coming off the boil. Melbourne and Sydney massively had their cycle already. They've already grown about 50% in the last 3 years. Perth hasn't had a boom yet. What can history tell us about Perth is that we have a mining cycle about every 14 to 18 years. We have moderate growth, then a retracement, then a boom. The last one we had was in the early 2000s, as you can see on the bottom right-hand side there. Now, let me tell you something. See if you can see the similarities to where we are in the economic cycle right now. In the middle of Australia here, you can see this graph 2002 to 2008. Interest rates went up 3.2% during that time. In the early 2000s, for anyone who remembers, we had a stock market crash. We had the dot-com crash. That's also happening right now. We had a war in Iraq, got now a war in Ukraine, and we had high inflation, and we had a lot of government spending in infrastructure and global demand for resources. So the commodity cycle went up. Perth did 147% capital growth. Sydney only did 27% over that time. So they had a big flat market for that period of time. So see if you can see the similarities to where we are in the economy right now. History often doesn't repeat exactly, but it certainly rhymes. We have the affordability index on the left-hand side here. Only 28% of Western Australians' income goes towards property, whereas 47, nearly 50% in Sydney. And again, their incomes on the right-hand side. WA's household income, $1,900. The only one beating us is Canberra. Michael Matusik did a study here, 6 times household income, giving you a sustainable house price. Melbourne and Sydney going down. Perth, 200,000 capital growth to the medium house price, which would catch us up to Brisbane, which is where we should be, 33%. On the left-hand side here, Perth has a property crisis coming with rental properties. Over the next 4 years, we're about 6,000 houses short getting built every single year. So we're going to have a 22,000 home shortage. And on the right-hand side, REIWA, record low rental vacancy rate ever relative to population. Our rental yields, which is the income you get on the properties, is higher than everywhere except for Darwin, which is not a good capital to invest in. I'm not going to talk about that. In the 18-year cycle, we talk about how in the first 7 years, it hits Sydney and Melbourne a lot harder. And we go through a mid-cycle turmoil. People think the world's ending, but then the government's to pull the rabbit out of the hat. They pull the purse strings, and we go into a big resource and infrastructure boom where Perth does very well on the back end. I go into much more detail with that when I spend time with people. Commodities prices peaked in 2012. That's why Perth started going down in 2014, 15, and now they're coming up again in the early 2020s. So guys, thanks for sticking with me. If this is of interest to you, who can I help? Working class people, 25 to 55 years old. If you earn over 100K, you pay a lot of tax. Have $150,000 equity in your own home or 100K cash to invest. You're ambitious, you're looking to build your wealth and your financial future, and you're interested in property, whether you're a beginner or an intermediate investor, more than happy to spend 20 minutes with you on a phone call just to clear up any loose ends for you, get to know you a little bit better, understand your financial situation. Then if it's appropriate, we can definitely organise a planning and strategy session where I can sit down with you for about an hour, hour and a half, fully complimentary, and just see if we're a good fit to work together. I hope that's been valuable for you guys. Love to hear your thoughts. I also post a lot of stuff on social media, and I'll make some other videos as well. Thanks for listening. Have a great day.